Alrighty guys, so in today's video, let's talk about the truth in regards to mechanical ICT trading. Now, what do I mean by mechanical trading? There's a few ways to approach this. Number one is using like a fixed risk to reward, being very mechanical about how things are. Like I need to get a 1 to 2, I need to do this at 1 to 1, I need to do this at 1 to 2. You know, when it goes 1 to 1, go to break even. That's one way of mechanical trading, which I started with. So a lot of you guys know I started trading the New York AM session. In that session, I will trade a 1 to 2, right? At 1 to 1, I go to break even, but we'll talk about some issues with that in a second. Pattern trading. So mechanical trading is also like pattern trading. You're just looking for a raid, a shift, and a return. But there are issues with that when you kind of don't get a better picture and have a bit of a look at the narrative that's defining the market. So we're going to get into that today, talk a little bit about that. But again, there's some things we're going to discuss, and I'm going to draw some illustrations up. These things may have happened to you, right? These things may have happened to you. So looking at the markets here, let's get into a few examples that happened to me time and time again, which have kind of caused me to be more of a dynamic trader and a flexible trader instead of like a really fixed mechanical trader. So firstly, the market might be doing this and trading the 2022 model. Maybe we're entering the silver bullet. You have a market structure shift and your return. Now, the first issue I have is I would be demanding, for example, let's get this up. I'd be demanding a fixed risk to reward. So maybe I'd be demanding, you know, a 1 to 3 or a 1 to 2, whatever it might be. Now, a lot of the time, what would happen is something like this. Price would go maybe like, I don't know, a 1 to 1.5, 1 to 1.6. And then what would happen with price? It would reverse. In my head, I'm thinking, how does this make sense? Like we've got a rate of liquidity, a market structure shift. But here's one of the issues with trading mechanically. You've got to consider the wider narrative. You've got to consider the narrative of why should the market go in that desired direction? And if it doesn't go in that direction or it looks like it's not moving there, should I at least take a partial? Really, really important to consider. So I think for me with mechanical trading, a big issue was that I wasn't paying myself enough as a trader. And in this case, I was demanding too much from the market. Because the thing is, guys, demanding a 1 to 2, unless there is an idea as to why the market needs to get there, it doesn't have to get there, right? So if there's no imbalance here, if there's no liquidity point here, why should the market go there? Just because you're going to get a 1 to 2 and you're going to put a nice little chart here showing a 1 to 2 doesn't mean it has to get there. And that's something really important that I had to learn, because I would be demanding too much from the markets. And unfortunately, this would cause me to take a lot of losses, but to also be confused and, you know, a little bit annoyed in the situation, thinking, why has this happened? And when I first started trading the New York session, this is something I found happen at least twice a week, right? We'd be continuing in one direction, and it wasn't until the lunch session or PM session that we reversed. By then it was too late and I'd already taken my 2 losses, so I had to move on. So that's something really important that I think without trading with a narrative and using mechanical strategies, you can demand a bit too much from the markets. Now, the question is, well, how do you modify this in a dynamic sense? How do you become a dynamic trader and still take this trade using the silver bullet model? So let's talk about some strategies that I implemented myself. And the first strategy is going to be taking partials. A lot of people might be against this, but honestly, partials, pay yourself as the trader, right? Pay yourself as the trader. That's the first thing. We'll discuss that in a second. Number 2 is to target low-hanging fruit. And number 3 is to cancel the trade if it's not working in your favor. Really, really important. 3 things that I've personally adopted. So for example, if you see price come down like this and it goes roughly about a 1 to 1.4, 1 to 1.5, you might ask yourself, okay, why does this happen? Why does this happen, right? And you're demanding too much from the market. So taking a partial, I think, is really, really important to make sure that you're paying yourself. And that way, guess what? If the price continues to run in your desired direction, great, you take that full profit. If it doesn't, at least you get something from the markets and then you can move on and you can look for other opportunities in the markets to take advantage of. So it's really, really important to keep in mind that. Another thing I want to talk about is instead of having a fixed risk to reward, target liquidity and imbalances instead. And let's get into some chart examples here so you can see what I mean. So for example, guys, this here would be the, the silver bullet. If I draw 2 lines up here, and we'll mark out this on the 30-second chart, 3 o'clock here, and then you've got 4 o'clock somewhere, somewhere over here. Now, in these situations, all of these swing highs offer points where you can take profits, right? And a big thing that's changed for me in terms of, dynamic trading and to not be, not be impacted by these issues as often is to take the low-hanging fruit. It's really, really important, especially if you're trading with Apex or prop firms that have that trailing drawdown. Take that low-hanging fruit. So what might that mean for a trade like this? You might enter right here. Where would your stop loss be? Somewhere there. And what would I be aiming for? 10 handles. Does it have to be 1 to 2? No. Can it be a 1 to 2? Yes. Right? So realistically, you can aim for a certain amount of handles. You can aim for that low-hanging fruit. But realistically, notice how in this situation, the next swing high here is 1 to 6.4, 1 to 1.64. And for me, that's sufficient. Right? I don't demand that it gives 1 to 2. If it does, beautiful. But I'd rather take those small, consistent wins over time, some of which have quite large risk rewards, others have 1 to 1, 1 to 1.5, and overall it equals out anyway. It equals out to be roughly about a 1 to 1.2. That was one issue I found happened quite a bit when I first started trading. The second I found was this, right? You get a rate of liquidity, a shift in structure, and we don't return. Now a lot of people think that you have to return, right, to the fair value gap, but you don't have to. And we're going to talk about some reasons why price doesn't return, and also some reasons as to how you can mitigate this, and some strategies I've used to still enter the trade, right, and still take advantage of that move based on the narrative. So many times before, when I was trading the mechanical model, like, the silver bullet model, 2022 model, I'd find that price wouldn't return, and I'd be asking myself, why doesn't it return? Why? It's meant to return. And then price would just sell off or like pump up in the desired direction, and I'd miss out on the opportunity. Now, that there in itself causes a lot of people to have that fear of missing out and then enter the trade. So it actually introduces more psychological issues than just simply missing out on the trade. And then you start to build bad habits. So one way that I've found that I've mitigated this is to use inversion fair value gaps, right? Inversion fair value gaps, like if price sweeps liquidity during a key time frame and then inverts a fair value gap, it's an opportunity to go short. It is. If price retraces, you can enter in another position. That's usually what I do. So I will pyramid into a position based on what price action is showing me. If we return, beautiful. If we don't return, doesn't matter because I'm still involved in the position. And what it all is about, guys, is about having that narrative. Why should the market move in that direction? Is there low resistance liquidity? Like why should it move there? And then based on these points, you can actually get involved in trades that otherwise you might have missed out on. So missing out on trades was a big thing for me using a mechanical model because I'd miss out all the time. The other thing was demanding too much, and I'd see price reverse. And we talked about, taking partials, number one, or number two, targeting the low-hanging fruit, or closing the position where you don't like what it does. Unfortunately, with mechanical trading, I've found that in the past, I'm too married on a bias, or I'm too married on an idea. And this is why I don't really have a bias in the markets. I'm happy to trade both directions. If the market gives me opportunities to go long, I'll take a long. If it gives me opportunities to go short, I'll take a short, right? So for me, price might do this, right? And let's assume, for example, this is another big one too. Let's assume that's Asian buy side, or let's assume that's London buy side, and you're trading, either London session or New York session. Price gets extremely close, and you're like, oh my god, it looks like we're reversing. I'm only taking like shorts if we sweep that high. And what often happens sometimes is one of two things, guys. One of two things. Either you've got SMT at the highs, or you have the 3 drives pattern, which I've actually got a video about the 3 drives pattern. Check that out if you want. But essentially, price doesn't have to sweep the desired high that you always want it to sweep, or the desired low that you always want it to sweep. And this is something I've had to learn over time, that if you demand too much from the markets with these mechanical models, either you're going to get left behind, right? Or it introduces those psychological issues with FOMO, fear versus greed. So what I've learned to do is just to flow with the markets. If we're getting super close to a target, I'll look at the opposing pair. Like if I'm trading the NASDAQ, I'll look at ES to see if there's SMT. And if there is, and then if we get the model we need, I'll enter the trade, right? So you're entering the trade based on time, macros or silver bullet, but also based on what you see, and being flexible or being dynamic with how you trade. So being dynamic for me means quite a few things. Number one, in terms of being dynamic, it means that you're flexible or open to being wrong. So in that case, you have a narrative, but if that narrative doesn't play out, you're happy to play the opposing direction. Number two, you're flexible in what you enter from. You don't always have to enter from a return to a fair value gap. It could be a fair value gap, it could be an inversion, it could be both, right? Really important. And you're able to take trades like this because a lot of the time the market might leave that till later on. and you might have seen this play out time and time again. So that's something that I really found helped me. Those three things that, you know, have helped me take trades, have a narrative, you know, form that ideal where the market wants to go. And that's one issue I've found with mechanical trading is I found I demanded too much. I'll just be focused solely on patterns, right? And even though, yeah, it is easy to manage and it is kind of like a set and forget approach, considering the markets move based on liquidity and imbalances, for me anyway, it works best and it makes sense. Instead of demanding just a random risk to reward that makes no difference, demand liquidity or imbalances that are low-hanging targets, low-hanging fruit. Really, really important to keep in mind. So, hope you guys got something from this video. If you like this video, give this video a like. And until next time, guys, I'll talk to you then. Peace.